Hello friends, welcome to my channel Financial Fitness with CA Ashima Able Younes. In this video, I'm going to talk about one of the most important and yet most ignored aspects of our life, which is financial planning. Financial planning can help you chart a course to get what you want out of your life. By helping you figure out how much money you have and where it should go, financial planning is a way to set goals and get on a path to achieve financial success. Here I am, CA Ashima, a professionally qualified chartered accountant and a certified auditor. I have worked as a partner and a director with one of the top 25 leading CA firms in India, which has also been a member firm of Deloitte, one of the big fours. After being associated with the firm for a period of 10 years, I moved to Sweden and worked as a senior financial consultant with a multinational and have also been working as a freelance financial consultant. In this financial literacy video, I will touch base upon steps to achieve overall financial success, global review of the bank crisis management, deposit insurance framework across the globe, where I will cover India, USA, Canada, and Europe. I will list out and explain a few top financial tips and will put all these into one juicy, super helpful video which would help the viewers in achieving their financial goals. But before we go ahead, I would request you all to please subscribe to my YouTube channel and also click on the bell icon in order to view the entire series on financial success. And if you like the video, then please click on the like icon and share the video with your family and friends, and make sure you watch the video till the end in order to achieve a path to overall financial success. Financial planning helps individuals determine whether they are on the right track to meet their goals. It outlines their path to overall financial success. Today, financial advisors face the challenge of providing financial services to address complicated financial lives and meeting their demands for fee transparency and value. From the best ways to budget to how to boost your earning potential like a pro, these nuggets of financial wisdom are as fresh as the day they came into existence. As they say, the first things first, so let's start with a few financial basics, and in the end, I'm going to give you some very good financial tips. So the first step to achieve overall financial success is to create a financial calendar. If you don't trust yourself to remember to pay your monthly or quarterly bills or taxes or periodically pull a credit report, think about setting appointment reminders for these important money to-dos in the same way that you would do for an annual doctor's visit or a car tune-up. Creating a financial calendar can be very beneficial for managing your finances. It can help you keep track of your bills and expenses and ensure that you pay them on time. This can help you maintain a good credit score and avoid late fee. By consolidating your calendars, you can keep your personal and professional lives organized. It will also help you track your earnings and spending habits, as well as to set budget milestones for things like savings and building your emergency fund. Let's get to the second point, which is track your net worth. Your net worth is the difference between your assets and liabilities, or in simple words, we could say it's the difference between your assets and debts. Assets would include things like your home, investments, etc. And liabilities would include the loans that you have to repay, for example, housing loan, personal loan, mortgages, car loans. These days there are many types of apps that can be used to track your net worth, like Truebill, Personal Capital, Pocket Guard, Net Worth Tracker by My Money Coach, and many more. Though using an app makes it easy to track your net worth, but I would recommend to use these apps only if it's a complex affair. Otherwise, I really don't recommend using such apps, as you can even do it in an Excel file or on a piece of paper or even in the notes in your phone. Knowing your net worth is important because it can help you identify areas where you spend too much money, Just because you can afford something doesn't mean you have to buy it. To keep debt from accumulating unnecessarily, consider if something is a need or a want before you make a purchase. It is the big picture number that can tell you where you stand financially. Keep an eye on it, and it can help you be apprised of the progress you're making toward your financial goals or warn you if you're backsliding. Let's get to the third point, which is evaluate your savings and debts in a clever way. Always check and compare your interest rates. Which loan should you pay off first? If you have more than one loan, then definitely the one with the higher interest rate should be paid off first. Let's get to the fourth point, which is some smart saving tips. Saving money is incredibly important. It gives you the peace of mind, expands your options for decisions that have a major effect on your quality of life, and eventually gives you the option to retire. Most people who are wealthy got there through a combination of their own hard work and smart savings and investments. Let's look into some smart saving tips when it comes to saving money in the savings accounts or in fixed deposits in banks. Although fixed deposits are not a very good investment option as far as the returns are concerned, because mutual funds, stocks, bonds, and alternative investment assets like P2P lending can give you a much higher return. However, if you look at them purely from the lens of safety, they can seem good options. And they are popular because, as the name suggests, fixed deposits, you get the fixed return on the amount you deposit. One should invest in FDs where you get the best interest rates, but the catch here is that it is always considered wise to limit your savings in savings accounts and FDs to 5 lakh rupees, that is 500,000 INR in a bank in India, as each depositor in a bank is insured up to that limit for both the principal and interest amount on deposits. But I'm going to tell you how you can extend this limit from 5 lakhs to 65 lakh rupees per bank. Deposit insurance protects your savings if your financial institution fails. You don't have to apply or pay for deposit insurance. So, in order to ensure that you get your money back in an unfortunate event where the bank goes bankrupt, or in simple terms, where the banks fail to repay its depositors, it would be wise to limit the amount of your FDs to 5 lakhs in each bank. However, this amount, as I told you, can further be increased up to 65 lakhs. But make sure you watch the video till the end to get to the answer. As we all know, the collapse of Silicon Valley Bank and the Signature Bank in March 2023 were among the largest bank failures in the US bank history, which has caused people losing trust in banks not only in the US but worldwide. Of course, we cannot forget the collapse of Lehman Brothers in 2008, which was the largest bank failure till date. Let's understand the deposit insurance framework not only in India but across the globe, and let's do a global review of the bank crisis management, especially for smart investors. Let's talk about the deposit insurance framework in India first. Currently, as per the Reserve Bank of India guidelines, which is the governing body for the banking systems in India, deposits with all commercial banks, cooperative banks are insured under the Deposit Insurance and Credit Guarantee Corporation, which is known as DICGC. Now the question arises, does the DICGC insurance cover of Rs 5 lakh apply for all the banks? Well, it's important to note that all commercial banks, including branches of foreign banks functioning in India, local area banks, cooperative banks, and regional rural banks are insured by DICGC. However, deposits in primary cooperative societies are not insured by it. Moreover, deposits in any NBFC, non-banking financial companies, or HFC, which are household finance corporations, or even corporate entities, are the ones which do not enjoy this insurance cover. The insurance cover includes all deposits held by a person in current account, savings account, fixed deposits, and so on and so forth. This limit was earlier only Rs 1 lakh per person per bank, but was increased to 5 lakhs in 2020 budget. If you have more than one account with the same bank, even if the different branches of a bank, then also you will be insured for an amount of 5 lakhs only. Though the insurance cover was raised to 5 lakh, this amount can be inadequate for many depositors. However, here's the good news that you should know how you can increase the insurance cover of rupees 5 lakh to 65 lakh or even more without spreading your deposits across different banks. So let's get to the second question, which is how to raise the DICGC insurance cover of rupees 5 lakh to 65 lakh for each bank. Depositors can open fixed deposits in the same bank, but in different rights and capacity. In simple words, if you open a fixed deposit in the same bank as a joint holder with your spouse or with your siblings, your brothers or sisters, or parents, one with your mother, one with your father, or with your children, or if you open a FD as a partner of a firm or as a guardian of a minor and so on, then all these deposits will be considered as held in different capacity and different rights. And each account will have the insurance cover up to rupees 5 lakhs separately. So ideally, you should segregate your investment in deposits to enjoy higher deposit insurance coverage even in the same bank. So if you have 13 such separate accounts of rupees 5 lakh each, then you can get an insurance cover on each of these accounts and thereby enjoy insurance cover of 65 lakh rupees per bank, and it will be fully insured. Now let me take you to the US. Well, not literally though. So in the US, the limit is 250,000 US dollars. For FDIC, which is Federal Deposit Insurance Corporation insured commercial banks, both like in the present times, you all must have heard and read the news about the Silicon Valley Bank and the Signature Bank. Both these banks in the US, they had a disproportionately low share of deposits less than 250,000 US dollars. As deposits below 250,000 US dollars are typically insured by the FDIC, this means that both of these banks were highly exposed to risk of a bank run. And that's what exactly happened. Let me explain you what the term bank run means. A bank run is the sudden or concerted action of many customers who withdraw their deposits from a bank. This usually happens when the bank is unable to repay or some of the customers come to get their money back, and when they spread this news in the market, most of the customers withdraw their deposits because they fear the bank will fail or become insolvent, which ultimately leads to the failure of the bank. A bank run can increase the probability of default or insolvency of the bank. A bank panic or a systemic banking crisis is when many banks suffer runs at the same time. Thankfully, we have the advice to ensure that we have investments which are insured. In those scenarios, you will never lose your money. Now, let me take you all to Canada. Again, not literally though. So in Canada, the Canada Deposit Insurance Corporation, which is known as CDIC, it insures deposits of up to $100,000 for savings with member banks. This means that if the bank fails, the government guarantees to repay the deposits plus the interest for up to $100,000 for a specified group of consumers who have their savings in the bank. Now let's talk about the EU. In the EU, the European Union, the deposit protection limit is of a maximum of 100,000 euros per person per bank as per the deposit guarantee schemes that will be reimbursed to compensate depositors in an unfortunate event of banks failing and going bankrupt. So this was a global review of the bank crisis management for investors. In fact, I would say for the smart investors, as you all have been with me till now, and the deposit insurance framework across the globe. Now let's quickly consider the alternatives to fixed deposits. So the question arises, what are the alternatives to fixed deposits? Liquid mutual funds are a good alternative to fixed deposits. They generally offer higher interest rates than the average FDs, and they also offer faster liquidity. What that means is that you can take your money out much faster in times of crisis without bearing much loss. In case of FDs, there is a liquidity risk as even though the bank fixed deposits can be easily liquidated or prematurely in cash these days, However, a penalty could be levied or some charges could be levied, and it might result in the loss of interest as well. With FDs, one should also consider the inflation risk. FD returns at times can be around the same as inflation or even lower than inflation rates, leading to wealth erosion for the investors. Other investment options can be debt funds, digital gold, and conservative mutual funds. The risk does rise with these, but so does the reward. Note that, according to the new government bill, any holding of cryptocurrency in India will be billed at 30% tax rate, which you should take into account when building your strategy. Plus, there are inherent risks associated with cryptocurrency market volatility. I will discuss more about investing in cryptocurrencies in my next video, so please make sure to subscribe to my YouTube channel and also to click on the bell icon so you all can see my upcoming videos as well. Let's go to the next question. Which investment option should one pick as an alternative to fixed deposits? Well, what you pick as an alternative to fixed deposit depends purely on you. You need to understand your risk appetite, investment goals, and the time frame you are looking at. If you're looking for a short-term gain, you might consider slightly high-risk assets like investing in stock markets, investing in equity. It can give great returns, but comes with a much greater risk. If you're looking for long-term investments, then equity mutual funds, international mutual funds, and even stocks are options worth considering. So now it's time to wrap up this video, and in the end I would request you all to please subscribe to my YouTube channel Financial Fitness with CA Ashima Able Younes, and also click on the bell icon, and please do like and share the video with your family and friends, and make sure to watch my other upcoming videos in this series that will be coming up soon, which will help you to achieve a path to an overall financial success. Thank you all for watching. Subscribe, like, and share. Bye bye.